All right. Welcome everyone to this very special webinar. This time we are switching things around and we are going to do a live stream today for the first time. And we also have a very special guest with us. Satwik joins us from Generational Capital. Welcome to the broadcast, Satwik. Happy to host you here.
Thank you.
Uh,
Thank you so much, Saket.
Great. So we'll wait for maybe another 2 to 3 minutes, and then maybe in the next 3 minutes we'll start the presentation. And for people who are probably streaming in or joining in for the first time, the link. If let's say you don't follow me or Satwik on Twitter, the link to follow us is in the description. Um, and before we get into the grander scheme of things, Satwik, why is it that you're so excited about this company and what really set apart for it? Obviously, we'll discuss it through the presentation, but why Vedant Fashion?
Well, so I rarely look at these new IPOs. So when everyone was looking at these new age IPOs, I always kind of look at very high ROCE, high growth companies which can possibly reinvest capital at high rates of return. So then this Vedant Fashion came, and I was looking at their numbers versus say an Asian Paint, Titan, Pidilite, Aditya Birla Fashion over the last 10 years. So they stood apart. So my research took around 3-4 months. It got listed, the price did what it did, but then I realized that it is one very special kind of business which is very tough to ignore if you are a proper growth investor. So that is how I came about this.
Great. So, I think we do have most of the folks already joining in. So if everyone can hear us fine, just drop a thumbs up or a okay in the live chat, and we'll straight away jump into the presentation. I can see a lot of people have already tuned in. Hi Anand, good evening to you as well. Uh, Great, Devojyoti, even we are excited. Uh, all right. So, welcome everyone. Welcome to this very special feed of Beta to Alpha. Now, for those of you who are not subscribed to the newsletter, this is how it looks, right? We make an attempt to post something every week with respect to a live webinar that we do, or, from time to time, there are various updates that we post. So, for example, yesterday we had sent out an update about this whole mechanism which RBI has introduced to settle foreign trade in dollars, etc. And this is something which you can go and check out the link, and this is something which we update on an ongoing basis. I actually have the privilege to host a very special guest today. Satwik Jain joins us from Generational Capital. Satwik runs a multi-family office, which is what Generational Capital is all about. And he's previously had an experience of working in multiple uh, companies, right from client associates to the Elara India Gateway Fund, and also in Deloitte. He also works as a venture partner with venture catalysts and looks at investing at the early stage startup space. But more than that, what is really interesting, or what really excites me about Satvik a lot, is this whole capability or this philosophy, which he's going to talk about through the course of this presentation, of buying stocks at a high P and selling it at a higher P, right? And he's also had a few multi-baggers to his name, right, from the likes of, let's say, a DMart or a Bajaj Finance or a Trent. And what is really exciting, or what really stands out for me about Satwik's whole mechanism of research, is how he really goes deep into going beyond the numbers and doing these really complex forensic checks. And maybe he'll also share a trick or two with us as to how can we as individual investors can do that same and apply those frameworks. So welcome to the webinar, Satwik. Over to you. Why don't you take us through what you have today?
Sure, sure. So I just prepared a brief deck about maneuver and the overall macroeconomic scenario with us. So I thought it would be better if I could just share that.
Great. uh,
Yeah, just give me a minute. So you guys can see my screen.
yeah.
Yeah. So I thought that, why shouldn't we start with the macros, basically, with all this pessimism around US CPI, raging inflation, what is happening in Sri Lanka, and a lot of pessimism about India. So if we just, look back and look at what we have done since independence. So most of you would be familiar with equities, so you might be knowing it, but I thought I would just, run you through it. So you should look at the how the trillions were added in the Indian GDP, and this is nothing but the power of compounding, which we tend to underappreciate. So the first trillion took approximately 58 years when India became a 1 trillion economy in around 2007-8 at the peak of the infrastructure bull run. Then the second trillion, it took only 7 years. So 7 years is basically, around a 7 odd percent compounding, and that's how we reach the second trillion. Now the third trillion, which is we just reached the third trillion, it will be done in around 2022 end. So we did it in around 7 years. So you see the magic of compounding. Now we are at 3 trillion more or less. Now the next 3 trillion, it would be done in, more than, like you can say, by 2030 it would be done. So what wealth was created over the last 75 years, the same would be created in the next 8-10 years. And this is nothing but the power of compounding, that in, nominal terms we would be growing at around 6, 7, 8%. Add inflation to that, we would be growing at anywhere between 10 to 13%. These are the broad calculations, right? So now, given this premise, so I try to capture the data of countries which had hit the $2,000 per capita mark. So if you look at this chart, in 2020 we were at around $1927. Currently we are have just crossed the $2,000 per capita mark, and this is after the
Satwik,
COVID.
I think you may have to represent your presentation, or maybe just
Okay.
change the slide, or just change the slide once. I think this, yeah. I just add this. Yeah, perfect. Go ahead.
Yeah. Yeah, so currently we are at a $2,000 per capita income mark. So I try to see across the globe what happened to countries which reached the $2,000 per capita mark and how they grew. So if you look at the journey from $2,000 per capita to $10,000 across various economies. So South Korea did it in only 13 years, which was probably one of the fastest from 1982 to 1994. China did it in 15 years, and the stock markets and the economy did wonders over that time, right? Japan from 1969 to 1981, it grew from $1,685 to $10,000 per capita, and the stock markets at that time grew at around a 22% CAGR. USA took the longest time, from 1960 to 1978. The economy grew, and the stock markets compounded at 16-17%. Now we are at a very interesting juncture. So what happens is, post we cross the $2,000 per capita, people buy more discretionary because the roti kapda makan needs are satisfied. So so my calculations are, given what has been the past track record of India, we should not do what the South Korea is doing, but more approximately what a China or a USA did, which is anywhere between 18 to 25 years, we reach a $10,000 per capita income. So now the whole point of all this is, we cannot waste this opportunity buying companies or growing at 5-10%. We have to look at companies which can double their earnings revenues in 3 to 4 years, where there is potential for earning re-rating as well as a valuation re-rating, right? Coming towards more the Indian side rather than the global side. So if you look at the evolution of the Indian household profile, in 2005, there were around 15 crore people, which was 15 crore households, which was 69% of the overall household, which was in the lower strata of the society. By lower strata, I mean less than 2.5 lakh, annual income. In 2018, this reduced to 43% from 69%. Given the pace at which we are growing, it will be at 15% only. But if you look at the top two quartiles, right? So the high and the upper mid segment, which is generally greater than 27 lakh per household income, as well as 5.5 to 27.5 lakh income, they are growing at a massive scale. So currently what is happening is one in every four household is either middle class or the high net worth individual. And given the pace at which we are growing, one in two households will be in the middle class or the higher segment of the society, right? And if you look at another data, so the $2,000 per capita, which I was talking to you about, if you look at the top quartile, basically, so there has been more than a 5x jump in the people which are earning more than $2,000 per capita, right? So the middle and the higher income strata are in a very good shape despite COVID-led disruptions. So coming to another interesting chart which I prepared. So what I have seen and I have realized is trends repeat globally. So what do I mean by that? So if you look at any wealth creation trend in the market over the last 20, 30, 40 years, it has been global in nature. And not only the wealth creation, the wealth destruction trend. So if you look at the mid 90s to the late 90s, right, from 1995 to 99, it was not only the Infosys and the Wipros of the world which created multi-baggers. There were companies like Yahoo, Amazon, and the likes of them, which became 100 to 100x, and it was a global tech boom. After that, it was a global tech crash in 2003 to 8. It was not only the your Jayaprakash infras and the other infrastructure companies like DLFs of the world which made wealth. It was a global housing boom. Like if you see the housing finance companies in the USA, there were Freddie Mae, Fannie Mae, which became at least 150 baggers before crashing. Same way from 2009 to 15, it was the pharma and the consumer boom. After that, it was the platform oblique the technology boom, which just crashed over the last 6 7 months. So now my another point is globally what happens in the USA and the China, it happens in India. So now if you look at the various sector compositions of various sectors, so there is a drastic difference in India. So if you look at the financial services, India is the only economy in the world which is having such high weightage to financial services at 24%, right? Then you look at other sectors like utilities, materials, along with that energies. So India is having much higher allocation to these highly cyclical and highly economy based sectors, whereas consumer discretionary, consumer staples, healthcare, companies which are reporting very strong numbers, their unit economics are very good, they are having lower allocation there. So now my thesis is that healthcare, consumer discretionary, by consumer discretionary, I do not mean the Unilevers and the Nestle's of the world, because they would not grow at more than 8 10%. It would be the likes of Titan, Trent, DMart, or say a Manyavar, basically the retail companies, which would grow much faster and capture higher profit pools, which should be form a higher part of the NSE 500. So now another chart I collated was of the overall profit pools of the NSE 500. So over time, what we have seen is the whole profit pools of the industry are captured by one, two, or three top players or challengers. Right, rest are marginalized. So if you look at the whole sectors, I can go step by step. So the overall NSE 500 profit pools are around 6.6 lakh crore. Out of that, IT oblique technology is around 91,000 crores. Right, if you take the top three players, which is Infosys, Wipro, and TCS, they capture more than 55 to 60,000 crores, which is like 70% of the profits. The rest are more or less shared by the likes of LTI, Mindtree, Coforge, etc. And then there are some marginal players. If you look at other sectors also, like NBFC financials, you can say Bajaj Finance, HDFC, Chola capture the majority of the profit pool, so on and so forth. Now, if you look at the consumer sector, right, the whole consumer sector has a profit pool of around 41,000 crores. Out of this, only Unilever, ITC have around 25 30,000 crores. So it is they have a lion's share of the profit pool. Now, my analysis is this 6.6 lakh crore will grow to at least 18 lakh crores over the next decade by 2030. And out of these sectors, right, it will be IT, technology, consumer, and healthcare, which would capture more incremental share of the profit pools. Now, in the consumer profit pools, incrementally, it would not be, ITC, Nestle, HUL, which would be growing at say 25% compounding. It would mostly be the retailers, as has been seen globally also. So if you look at the US market also from 1990s 2000, it has been Walmart, Target, which have been capturing majority of incremental profit pool and incremental growth rather than these Nestle's, Unilevers of the world. Now we look at the Indian consumer retail sector, right? So since 2012 to 20, the GDP of India grew from around 12,048 crores to 2,900 crores, whereas private consumption grew from 700 odd crores to 752 crores, right? Whereas the retail sector, it grew fastest, basically, more than 150% from 370 to 850 crores. And retail is also a very good sector where, each subsector has, two or three players which are capturing lion's share of the whole industry and are doing 20-30% ROCEs. You look at any sector, if you look at the grocery retail sector, DMart will be there, Reliance Retail will be there. In the jewelry sector, Titan is there, footwear, Relaxo, and now Metro Shoes is there, so on and so forth, which we'll talk about later. When the industry itself is in a tailwind, and if we identify decent companies there, a lot of wealth is to be made, and these are very stable sectors, as these are sort of low ticket items and essential consumption in nature, more or less. Now, after we have established a broad thesis, so I would like to know, Saket, you have any questions, or we should jump towards the intricacies of maneuver?
Yeah, so I think audience members, up until now, we don't have any questions. But if anyone has any thoughts, any questions, any feedback, feel free to use the live chat. Satwik can continue with the presentation, and maybe we can take a pause here for a minute. And if there are any specific questions, otherwise, maybe you can continue. We can wait for a minute or two before we get into the main part of the presentation. So, Satwik, whatever basically you've presented up until now, that basically points to the fact that right now India is at that inflection point of $2,000 GDP per capita, and that is
Right.
after which when magical things happen. And once through, let's say, we've seen that in multiple countries. And what was another very interesting thing, if you can just put that slide back, was the whole profit pool leadership that you spoke about, right? In different industries there are these specific profit pools. So obviously there's one school of thought that someone is going to come and start garnering a lion's share of this profit pool, but at the same time there'll also be let's say the profit pool expansion also kicking in, if
Right,
I'm not
right,
wrong,
right.
right? So that I think is quite interesting for viewers, I mean for me as well, to note, is that and finally when you spoke about the fact that the entire incremental value creation, if you can come to that as well, is how retail has dominated that. Because and it sort of stacks up, right? Once you, I mean, take care of roti kapda makan, the GDP per capita improves, and then the discretionary
Mhm.
spends start kicking in, and that's where retail gets an edge. So I think that's a great uh, groundwork for context setting, as even Adhyayan mentions. I'll just put his comment up. So there are a few questions before you get in, maybe, or you can cover it when we get
Okay.
into
I
it.
I think up to
So
you. We can do it now or later.
yeah, yeah. So the first question is from Anand. Why retailers like ABRL or Arvind never make money? And there's another question from Sunil who says, what is DMart's ELDP strategy? I think this was mentioned somewhere in your slide. Um, so if
Right. So
you
I
have
think
any.
what I will do is I would straight away cover the next slide. I think both these questions would be, covered in the next slide which I was presenting, and then we can uh, see the later questions.
Great. In fact, just a follow up to Anand's question, I'll just put that up as well. And this is sort of interesting, right? That Indians have always been bargain hunters. How will they allow retailers to make decent ROC? So I think
Right,
this
right.
is quite interesting. We can cover that. It's Anand actually a mix of multiple things. It's
So
not
this,
just
these I will cover with the DMart example and the global example. So
great, great.
I normally look at the global companies and then come to India whenever a company is thrown to me by say Saket or anyone in my investor community to research. So I realize that there are many ways, like there are many ways to reach God, but only one way to reach moksha. So same way in the retail sector, you have to have growth and return on capital employed, and that return on capital employed has to be reinvested back in the business. That is how value is created. There are various strategies which globally retailers have adopted, same way Indian retailers have also adopted. So I will take them one by one. Say DMart's ELDP strategy, which is the everyday low price strategy basically, right? So what DMart did was, so they open up a store in say outskirts of Mumbai, and then they adopt a hub and spoke model. That okay, one store is opened in Thane, then around that only within say a 7-8 kilometer radius, 2-3 more stores will be opened. So now when they have to procure material from say Nestle, Unilever, or whatever these other FMCG companies are, they have that power, that since they're buying in the large quantities, they can ask for longer working capital cycle and discounts also, right? So it procures at a lower cost from the FMCG companies. Then the stores are very, you can say, low maintenance in nature. Like you would not find a this, like, what is that name of some future retail store is there, which is sort of very high end, or you can say any high end retail shop, right? So that kind of thing or experience you would not find at DMart. So they have cut the cost on the infrastructure of the outlet also, and they purchase the property more or less like 70-80% of the properties are bought by them, so the rental increment also does not happen. So with this, what happens is they are able to give the lowest price to the customer. So now when a person is buying a grocery item, so normally he would not mind traveling say 5 kilometers more also, but he wants the lowest cost for the grocery item especially. This is what DMart has mastered. So there is an interesting fact that the first 8 stores took, I think, around 8 years, and now, as per the recent investor presentation, I think they are at 293 stores. So this is what they are doing, a calibrated expansion. And if you look at the companies which failed, like a Subiksha in grocery retail, or say in the clothing retail companies like Pantaloons failed, so many others. Aditya Birla Fashion also was not doing pretty well, recent till recently. And this is Aditya Fashion is a different company which I mentioned here. It is a small cap company, right? So this is broadly what is the DMart strategy, right? Now if you look at globally also how wealth has been created, right? There are companies like Walmart, Costco, which did the very similar thing. They adopted a hub and spoke model. They bargained with the FMCG companies, and they grew region by region rather than haphazard expansion in the grocery retail. So this is where retailers make margin, not on the margin from the customer, but on the asset turnover and the higher footfalls in the region for grocery retailers. Now there are other successful business models also, like say Relaxo footwear. So it is more or less priced at a same price as what a local non-branded version would be there, which is around, its average selling price right now is around 140 rupees. They have chappals for 100 odd rupees also. So they are only making a 10 rupees margin on their overall footwear market, but they are selling 20 crore pairs of slippers and footwear every year. So that high basically that high turnover and that velocity, it leads to Relaxo making decent profits. So Relaxo also does around 18-20% ROCE. It is one of the few companies I have seen which has done both a value growth as well as a volume growth over good 20 odd years. uh, then coming to other companies, if you look at the clothing segment, so the clothing segment is a very tough segment, right? Because you have to maintain your inventory, you have to be updated with the latest fashions, right? And then you have to figure out the rentals and all. So Trent has been, I think, the only clothing brand. So now Manyavar is there, but if you look at the more or less the clothing brand, Trent is the only one which has done a decent job in India. Now I'll tell you why. So look at who is the third richest man in the world. It is the Zara founder. What did he do? In a toughest industry, he made a brand out of Zara, right? So how did he do that? He innovated a concept called everyday fast fashion. So they bring out a new version of a cloth, or of whichever the latest trend is there in the fashion week, the Milan fashion week, at a normal price. They keep it on the shelf for 2 weeks. If it is selling like hotcakes, they increase the supply. If it is not, they just shut it. They do not keep the inventory. So this is how Zara did a very good business model, and it is where it is. So now Trent has a JV with Zara, right? It is a 50-50 JV with the Tatas, right? So now they understood the business model, how Zara is doing business globally as well as in India. They mastered the business first with Westside. So Westside had only 8 odd stores for the first 5 years. Right now, they are at more than 200 stores. So over the last basically 5-6 years only, they have hyper scaled. Basically, Westside at a store level is now doing a 50% plus ROCE, right? 50% plus ROCE in a clothing brand, right? And now the icing on the cake is they have launched Zudio. So Zudio is basically, you can say, the value migration from your flea shops to mall with the Tata brand name and the Tata comfort, and at the same price point. So you will basically get a shirt and a trouser at 100 rupees, and normally in the tier 2 tier 3 cities it is a very attractive price point and a very good value proposition. So now Zudio is growing at more than 30% CAGR, and they are also in the hyperscaling mode. Zudio also at a store level is doing more than a 40% ROCE. So in this trend, basically this Westside and Zudio, I think they should do very well. Then there are other good examples also, like Manyavar, because they cornered both the supply and the demand side, leading to a category creation. Metro Shoes, the recently listed IPO, so they, the optionality there is basically the fit flop scales up, and at a store level, basically every 2 years, the investor gets their money back. If you put up a franchisee of Metro Shoes, normally they are doing a 70-80% ROCE at a store level. So that is the efficiency of the company. Apart from that, there is Vmart, which is doing decent, one of the few companies. Now this company name is Aditya Vision. So this is a small cap company. I by mistake wrote Aditya Fashion here. It is also doing a 20-25% ROCE. Then Jubilant Foodworks, Domino's, franchisees there. Apart from that, obviously Titan is there. So these are various models of retail, how money has been made in India as well as globally. So, and now I think if you have any other questions, otherwise we can deep dive into the business model of Manyavar.
Yeah, so there are a few questions, Satwik. I think before we get into maneuver, we can sort of take them up. So okay, Amit has a question. There's a great opportunity size, but please throw some light on cash conversion cycle, working capital days, inventory days. I think we'll cover this when we do a
Right,
deep
right,
dive,
right.
right? So that's something that we can take up. Vedant has a question. Margins of a quick fashion company versus a e-tailer or a hyper discount policy. So any thoughts on that?
Right. So, normally I have seen is in the e-tailing market, barely companies have been profitable. And in this fast fashion company, especially if you talk about what Trent is doing in, say, Westside Zudio, so margins are very decent there. And more than the margins, I look at the ROCE level, the return on capital employed. So, at a store level, they are doing 30-40% ROCE and reinvesting it back. The same store growth are more than 15-20%. So I think that is decent enough there. And there are actually no proper plays also, if you look at e-tailers as such. If you look at the Indian markets in India, in fact, Trent can be a good play because now Tata New is there, and if Tata New can do what they are promising and what the hype is, I think Westside and Zudio can do pretty well there.
Yeah, interesting. Uh, okay. Let me go back to the comments, or rather the questions. Uh, okay. This is something. Okay, Vipin has a question. Why do you think Manyavar will stand out from the crowd and can become next Titan? I think Vipin is something which we'll now get to it, but it's important to set context before I think we get into it. So we will hopefully, Satwik will hopefully try and outline that for us. Vipin also mentions that Reliance is expanding into retail and acquiring different brands. So any thoughts on that? How are you looking into it? If on the whole
Right, right,
competitive
right.
landscape
So
intensity.
Reliance's the grocery retail business is doing a decent job. If you look at their same store growth, their return on capital employed, everything, and how they're managing the stuff. But their other businesses, I still haven't gathered the confidence as to how in the retail segment only, how they are doing and what will be the unit economics. And because there are so many moving parts to it, so I have not been able to figure that out. And more or less, in the unlisted market, because if you have to only buy Reliance retail, you have to go to the unlisted market. The As of today's price, the market cap of Reliance retail itself is 20 lakh crore, which is much more than what Reliance's overall market cap is. So that is why so I have tried to. I will look at it if and when the retail IPO comes. Saket, I cannot hear you.
The question is, why is there such a huge interest in ethnic wear segment? Recently, many companies are investing heavily in this segment. ABFRL and Reliance are partnering with various designers, and companies like Raymond are too eyeing growth in this segment. So, any thoughts on that, or is everyone trying to get into this space because they've seen now a category leader do about 1,000 crores in revenue? Any thoughts on that?
Right, right. So if you look at the overall market size of, if you combine, the men's and the women's ethnic wear and the wedding wear, it is broadly as large as a market as what the jewelry market is, which is a 4 lakh crore market. Now, most of it is unorganized, and most of it is, the female crowd, basically. So there is as such no dominant player, and I think it will be very tough for a dominant player to be there. Maneuver has done what it has done, but there would be no monopoly kind of a player, like you can say an Asian Paint kind of a company or a Naukri.com kind of a company in the job search market here, because it is too personalized, too fragmented. So that is why people are eyeing it, but the unit economics are to be seen. So as we go down the presentation, we will delve into the acquisitions what Reliance did, and Aditya Birla Fashion also did with Manish Malhotra, Sabyasachi and all, and you see their numbers and what Maneuver is doing, then you decide for yourself. It's a very tough segment.
Fair enough. Nitesh has a thought. He mentions that Max Retail is also doing a great job in fast fashion. They are probably launching about 6 seasons everywhere. Is this? I think this is probably in line with what Satvik you mentioned, what Zara has done, or let's say what
Right,
Trent
right,
is even trying to do. So
correct.
that is something. Vedant has a follow-up question: is Maneuver cornering both ends of the market, or is Maneuver cornering off both ends of the market considered unbreakable? If not, how will they cope with the changes?
So I think how they have cornered both the ends of the market is, first is the demand side, and due to whatever the advertisements they have done with, say, Alia Bhatt, Ranveer Singh, so this Kartik Aryan and all, there was this perception of, and the segment they were targeting. See, Manish Malhotra, Sabyasachi are targeting the very, very high end crowd, people who can afford, say, a 16, 15, 20 lakh lehenga. But Manevar was targeting, that middle class, which is going to your normal markets, but now they have a pan India brand out of it. That is how they did what they did, and I am pretty confident that from here also they will be doing a decent job. And then the other part of it is the franchisee part, which we'll delve more into when we, go ahead with the presentation.
Okay. Anand, as a follow-up question, in US, Target, JC Penney, etc., all retailers have nosedived. Any reason why? Uh, I think probably it's
Right.
got
So,
to do with the broader sell-off. But if
yeah,
there's
yeah.
any,
Now everything has nosedive. So you
great.
look at the best of the best companies, everything has nosedive. So
Okay, I think this is a question from your first half of the presentation. What exactly is private consumption? Can you give examples? It's probably more got to do with your personal, let's say. I mean, any thoughts here, Satwik?
yeah, so basically that, roti kapra makan, more or less that, and whatever we are spending through our personal capacity, or whatever, say, a Bajaj Finance is lending to, if you can put it that way. You can say your mobile phones, whatever you are spending on the FMCG brands through the retailers, jewelry, this wedding shopping, so on and so forth.
So basically, it's got to do with the whole aspirational end,
Yeah,
or let's say that can be.
aspirational and the basic necessity, so it covers both.
Okay. Uh, I think there are a couple of other questions as well. Maybe we can take it quickly and then take a cut off and then
Right,
get
right.
into maneuver. Amit has a thought. Metro shoes, can it be disrupted by e-commerce online stores? Any thoughts there?
So, now what the interesting part which is happening is, so these current players also, they are pivoting towards online. So if you look at, say, a Metro and a Relaxo also, they are also doing, high single digit sales from the online uh, platforms. So it will be a very interesting thing to see ahead also. So, and it is not only with this footwear market. You look at what Bajaj Finance is doing in pharma, what JB Chemical is doing. All of these old companies are pivoting towards tech. So, and so it will be good to see what is happening. But these old companies right now also, they are decent enough pivoting towards tech to see this competition from the online places.
All right. Chintan has a thought that Fab India is also planning an IPO soon. Uh, I mean, you've done some benchmarking there, so we'll probably see some
Right, right.
numbers. Um Guru has thought why Nestle Unilever couldn't grow as much as Walmart did in the US. Can you explain the reasons for the same?
So see, so there are, if I put it this way, there are two kind of growth. One is the penetration-led growth. Say the penetration of the retail market is right now only, say, 2-3%, right? And then the other is the volume-led growth, where, say, Nestle has captured, say, 90% of the baby food market. So so then it has to grow volumes. So now the volumes can only be grown at, say, a multiple of the GDP. Say the GDP, the nominal GDP is growing at, say, 10-11%. Nestle can max to max, grow at that level when it has itself captured the whole market. But when a penetration led growth is there, say DMart is right now at a 293 store mark, Reliance Retail itself is only at a 5,000 store mark, right? So the scope of opportunity is more than 10, 20, 30x. So that penetration led growth is very, very fast rather than this growth, because you have captured the market, or say a significant part of the market.
This sort of comes back to your whole point on profit pool leadership, where
Right.
one obviously
So
is you
that,
get market
so
share.
one thing is, you just invest in the leaders. It is very tough to beat the Nifty there, because they are established leader. Everything is priced in. But where the incremental delta comes in, that is where the whole wealth creation will be there. Say from 36,000 crore. when the consumer profit pool goes to 1 lakh crore, I'm pretty sure companies like Titan would play, an increasing part rather than a Unilever and an ITC.
Okay. Sandeep has a thought. In ethnic fashion, previous IPOs like TCNS have not done well, maybe due to the fast changing taste, highly customized needs. It's a tricky market. Any thoughts on that?
Yeah, so normally I've looked at TCNS clothing. So if you look at the W, Aurelia, and they have a couple of other brands also, the store level ROCE are, at 16, 17 odd percent, and it is not sort of a consistent kind of a growth. Here, Maneuver is an exceptional business model. Its growth, ROCE margins are better than even say Titan, Unilever. You can name any consumer brand. I'll show you data from their investor presentation also. That is why I looked at a company like this, because not making money will be, normalcy. Having these kind of margins, ROCE and all, is an exception.
Great. So, Satvik, I think that more or less is what we have in questions. You can jump into straight
Right,
away
right.
telling us what is it that sets Maneuver apart, and what should investors look into the parameters that you've discussed based on your framework.
Right. So I forgot to make one disclaimer. So basically, I run this portfolio management service. So, so everything and anything I say, you can be self assured that I would be having a vested interest there. And it is all till now. I can change it tomorrow morning at 9:15 a.m. also.
Yeah, and obviously we have this disclaimer as well in the presentation. So,
Right,
uh,
right.
none of what Satvik and I discussed should be construed as investment advice. This is just a framework from an educational perspective to give you a lens as to how do, let's say, different fund managers look into perspectives and arrive at conclusions. So, over to you, Satvik.
Right. So now, whenever I'm looking at a company, I normally look at a large total addressable market. Then the company should be capturing significant part of the profit pool. Normally, it should be, 10, 15 odd percent of the overall profit pool, and it should scale up to 50, 60%. And then you look at selling the company, and then it should have the ability to reinvest the profits back into the business or pay it out as dividends and still grow. Right, so these are the broad factors which I look at, and then obviously the clean accounting and the corporate governance comes in. So we'll try to figure out how Maneuver fits in there. So the total addressable market construct, so it is very, very similar to what a Titan has been doing. So if you look at the overall jewelry market of say 2020, right, the industry size is around 4.8 lakh crores. Organized share is around 32%, which is more or less one third, right? So the organized share is around 1.5 lakh crore. Titan jewelry share was around 16,000 crore, which is more or less 10% of the market share, right? So, and the second competitor, which was Kalyan Jewelers, it was at 5 odd percent. So, you have an industry which is 70% unorganized, and the leader having only 10% of the organized market share, and the overall market share was around 5-6% also only, right? So and you just jump into Maneuver, right? So the whole men's wedding market is only around 13,000 crore as of now, right? Organized players comprise of around 20-25%, players like say Jahapana, Manish Malhotra, so on and so forth. And the Indian wedding market is more or less around 73,000 crore, and even lower player from organized players, because these are very bespoke designs, right? If someone is getting married, especially a woman, so the lehengas are ordered say at least 6-8 months beforehand, and they take at least 4 months to be prepared. So now Vedant Fashion Limited in the men's segment has around 1,000 crore share, has around 10% of the organized market. That is 26 times of its nearest competitors in men's, which is Jahapana. And you just look at the margins, right? 40% EBITDA margin of Vedant Fashion. No one else is even touching single digit EBITDA margins. So there must be something special and it is not a one trick pony. This has been there for past 5, 10, 15 years, even in COVID, right? So something special was there which made me very very interested in the business here. So you forget the wedding retail businesses because rarely they are listed and their margins are like pathetic, except Manyavar. You compare them to other players in the clothing market. Go Fashion is the second best, right? At 21% adjusted EBITDA margins. Then comes Trent, then Vmart, TCNS. No one is close to what a Vedant Fashion is doing. So now you must be wondering what is the magic of Vedant Fashion, right? So, if I had to start a retail shop, say a normal grocery retail shop, or say any say clothing retail, what would I think, or a normal person would think? I would open up one store. Some profit would come, some I would keep for my expenses or say investing in the markets, and from the rest I would reinvest to open up a new store, right? And then the story continues till I scale up a lot. But what Mr. Modi did, he followed a franchisee model where incremental store openings, the company does not have to put in any money. The stores are owned by the franchisee and they are operated by the franchisees. And I'll take you through the details, but more or less what happens here is the handling of the store operations are also taken care of the franchisees. And the Vedant Fashion, it focuses on the more complex aspects, which is the branding, assortment, which are the up to date designs, and where all new places they have to go, or where all new franchises they have to look at. This is very very similar to Titan's approach. So that is why I looked at it that this is probably a Titan was there say 15 odd years back, wherein two-thirds of its sales come from stores operated by franchisees, right? So this year the annual report they mentioned they were around 70% sales, but broadly till last year they were around two-third sales. Also, both Titan and Vedant Fashions, they have been able to do extensive town coverage of broadly 220 to 30 cities. So now this Vedant Fashion has basically two franchisee models. One where the Vedant Fashion bears the rental cost, and more or less the franchisee owner gets an 18% odd margins. And in the second one, where the franchisee bears the rental cost, uh, and the margins are much higher at ballpark 30%. So I talked to a few franchisee owners and to this Vedant Fashion people also. Normally, what happens is in any 3 to 3.5 year period, right? The investor gets his money back, which is broadly an IRR of 20 to 24%. And if I as a fund do that kind of an IRR, I am pretty happy over say a 5, 10, 15 year cycle. So it makes a very compelling business proposition for an investor also. And the proof of the concept is in people not leaving. So more than 90% of the sales are from franchisees. 75% of the franchisees are 3 years plus old, and only two-third of the franchisees operate more than two stores. So if someone is putting say 1.5 crores investment into franchisees, hiring people to run it, so unless they generate a decent IRR, they would not open new stores. So this is the proof of concept here, right? And going ahead also, I think it would scale up in a very asset light way, leading to high ROCE and high growth, which is what we as investors look at. Now, if you look at the market also, right? Both the first we look at the Indian menswear, right? So, say in the revenue range of more than 7,000 crore in FY20, right? There was 700 crore in FY20. There was only Manyavar. Now Manyavar has reached 1,000 crore, and you see there is literally no other player. So all of them are less than 100 crore. Be it Jahapana, this ethnics, Swayamvar, and all. There is literally no player. So it is the only one literally by far in the men's segment. Now there are a lot of optionalities there, especially in the women's segment where there is some sort of decent competition also. So that we'll talk to in some later slides. But even if you look at the top ones there, like say Sabyasachi, Ritu Kumar, Anita Dogre, and Nalli and Manish Malhotra. M- Manyavar, Vedant Fashion as a whole is much ahead of all of them. No one is even close to Vedant Fashion, whereas it is doing literally nothing in the ladies segment, which is the mohe. So that is the big optionality there. So now I always look at what the optionalities are, because the consistent growth of Manyavar, which is the wedding brand, which is the men's brand, it will give the steady sort of growth. But what the market might not be factoring in is the optionality of what these other brands would be doing. So I'll take you through each of them. But the most interesting one of them is Mohe, which is the female brand, right?
Satwik,
So
before you get into Mohe, right, just a small thought. I mean, you can keep your presentation. I'll just a small question. Now,
Mhm.
when you say that Manevar has this crazy payback metrics and the kind of returns, or let's say the payback that, let's say, a franchisee owner makes, how is that different from, let's say, some other players? Why is it that Manevar is able to score that well? Is it because, let's say, the brand and the sales sort of ensure that the cycle turns faster, or is it something else? Like, for example, if I just draw a small parallel here, if we see how Jockey really got set apart from, let's say, some other hosiery retailers in India, was they went straight away into the EBO model and went directly to the consumer rather than doing the whole wholesale led model, which is why their working capital cycles went in a different direction. What is it that
Mhm.
sets Maneuver apart in terms of, let's say, these epic franchisee payback numbers that you talk about?
So, what I have realized is that in most of the sectors, I'm not saying all, if you can succeed with a franchisee owned, franchisee operated business model, or a franchisee owned, company operated business model, you can hyperscale very, very fast, because once your proof of the product is there, right? Then you do not have to think that, okay, mera cash flow aega, I'll pay off the salary, then I will scale up to new cities. You can appoint franchisee owners who are willing to take that risk, because they are seeing that a decent IRR which can be there. So I'll give you an example from the diagnostic industry. So we ourselves used to run a diagnostic chain basically. So what happens is, why is there only one Dr. Lal and one Metropolis, right? It's a overall seven. Now the stock price is doing what it is doing. That is a different story. But why is Dr. Lal Metropolis kind of monopolizing the whole market? It's a 70,000 crore market. Organized is only 15 20 odd percent. Dr. Lal Metropolis of the overall market are only 3 4%. But why have they reached that scale where no one is reaching? Because they pioneered the franchisee model. So you look at all these collection centers of Dr. Lal, right? No one will be as such owned by Dr. Lal. All of them will be owned by the franchisees, more or less. So that is why they could scale it up to pan India, more or less, right? First they captured the north market, then they are doing the west market. In the east market, west they acquired Suburban Diagnostic. Same way with Jubilant Foodwork, because they are opening up a lot of franchisees. So what I have realized is, if a company and a franchisee owner would not put in money unless he's seeing a decent IRR and a strong brand, right? So that is the more or less thing, that companies can hyperscale when they succeed with the franchisee model.
So it's basically a mix of multiple factors, whether
Right.
it's location, or ensuring that you are set for hyperscaling. So
Right.
yeah, I mean, you can continue with your presentation.
So now Manyavar. So Vedant Fashion. So Manyavar is doing what it is doing, more or less. It has reached 1,000 crore sales. It is the only one in the men's wedding wear market, in the listed space at least, right? So now what happens is, the women's wedding wear segment is 10x or more of the men's wedding wear segment, right? So my blue sky scenario for Vedant Fashion is Manyavar, Vedant Fashion cracking this market. What is the proof of concept here? Mohe took only 5 years to reach 90 crore. The ladies brand Manyavar took 9 years, right? So more or less, it scaled up at say 40 50% pace faster than what Manyavar did, right? Now, in the last con call, the son of this Mr. Ravi Modi, Vedant Modi, only I think this Amit Jeswani from Stallion was asking him, when will you scale up Mohe? Because that is where the optionality lies. So he said that they will scale up at 10,000 square feet per square feet when they reach from Mohe stores. Currently, they are at 6-7,000. So now I will keep on monitoring this every quarter on quarter, that once they reach 10,000 stores, 10,000 per square feet from Mohe stores, then how the scale up happens. So, then the business might only be at a different level, because then the addressable market will increase, it will start showing in the numbers, and then, good things might happen with this. And then there are other brands also, which is everyday festivity wear Manthan. So now what these Vedant Fashion guys realized was that okay, this maneuver is only for the wedding wear, which is like very rare occasion, or you can say for your friends and family. But your everyday wear kind of clothes, which in office you can wear for special occasions. So basically your TAM increases. So there they included this Manthan, and its price points are also very very decent, say 150 rupees kurta to 200 rupee pajama, that kind of things. And this is at the economy segment. And now at the HNI segment, so now what they have realized is, some people might be coming to Vedant Fashion stores looking at very premium brands which should be competitive with, in the men's segment. If you look at, say, a Shantanu Nikhil or a Sabyasachi, Manish Malhotra is obviously at a different level. So they have tried to upsell the Manyavar customer to Twamev. So, and people are generally price unconscious in that segment. So this is also right now in, the infancy mode. If this also scales up, so, the average selling price of VFL as a whole, currently it is at 4 or 1,000 crore, that can also increase. So these are, three odd optionalities, which I think out of that Mohe, if it does, I think this Vedant Fashion would do pretty well from there. Now, I'm a normally a very conservative investor, so I try to look at the historical data, right, of what the company has been. But this was sort of very exceptional only. So, I tried to. So this was basically from their investor presentation only at their IPO roadshow, the Vedant Fashion Limited. So you look at their 3-year operating income CAGR, right? 10-year operating income CAGR is around 30%. 3-year was around 15%, right? 30% was, I think, only Aditya Birla Fashion did more than that. That was also because of a very very low base, right? No other company has been able to do that. And these, we are talking about consumer monopolies like Asian Paint, Titan, Dabur, Marico, Pidilite. Now you might say, okay, they were at a larger base. What about the other parameters? So you look at their operating margins. No one is close to Vedant Fashion Limited. It has a 43% operating margin, right? No one is close to even half of that. So the next best is, here you can say a Pidilite at a 22 odd percent. So you see the gap. These monopoly like Pidilite, Page, Relaxo are doing, normally you can say 15 to 20, 22% margins, whereas Vedant is doing around a 40% plus margin. Now you look at the ROCEs, return on capital employed, 41%, and these are all throughout the cycle they have been able to maintain, the 35% plus ROCEs. Very very few companies, or I can say literally no company, and these I'm not talking about any small company, some random company. These are all dominant consumer companies which have created very decent wealth over the past 10, 20, 30 years. Probably one of the best performers across cycles. So these kind of companies deserve to be looked at now. And then the optionalities are there, so I was like, it looks decent. And now there is one quote also from Ravi Modi. He wrote in an article to Forbes to why this is happening. So he said there is no capex, there is no fixed asset other than the corporate head's office salary, because everything is franchisee, right? Every rupee of working capital can generate an equal rupee of pat, which is broadly 90-95% of free cash flow. Only Unilever does a ROCE of 100%, and they are the second. So if you look at the overall consumer basket, they would be either number one or number two in the ROCE bracket, and they are growing at 25, 30, 35%. These FMCG companies would not grow at that rate. Imagine the value that is being created in the company. So this was broadly about the business, and now, if Saket, you have any other questions, or we can delve into the forensics of Manyavar.
Yeah, I think we'll take a short pause here again. Folks, if there are any questions related to Maneuver, whatever Satwik has covered, right from, what is the franchisee strength that Maneuver has demonstrated, the payback periods, or what optionalities, as he discussed about Mohe. So, we'll be happy to take that questions before we get into the forensic analysis, and maybe Satwik can try and outline certain frameworks. So we'll take a short pause here. Maybe we'll see for questions. Um and one more thing, Satwik, that points out, right? Like you mentioned for Mohe, the GDP, or sorry, the revenue per square feet, the number that they are looking for is about 10,000 rupees. Any sense as to what this number is for, let's say, like a Trent or a DMart, if you've seen or if you've done
Right.
otherwise? Right?
So I think for Trent it was at around a 12,000 per square feet. Trent also, it varies. For Zara it is very very high. For West Side it is lesser because it is into the mid market, and for Zudio it is much lesser because it is into the everyday, and the lower segment sort of.
Okay. So, what would be, let's say, the highest number that you've seen in India for
So
any
highest I
retailer?
think it is of Zara, if I'm not wrong, that is of around 25,000 per square feet.
And Zara is this operated apart from the JV that you talked about with Trent,
No, no,
or
no.
is
So
it?
any Zara store, so it comes under Trent only in India.
Got it? Got it. So, okay, we have a few questions. Let's take them up. Uh, okay, Amit's earlier question. Uh, Okay, let me put that up. Lokesh has a question. Something on the sourcing capabilities which aids to their operational profit. Any thoughts there?
Right. So
I'll.
sourcing, what they have done is how this industry normally works is there are no large factories, and those belts which you see in the films, in the wedding segment. These are mostly for companies like, say, Aditya Birla Fashion doing a Van Heusen, where 100 same pink shirts of 42 size have to be printed, or say this Trend, from its west side, doing this, where 50 shirts or leggings of the same batch have to be printed. These are very very customized segments, where even if a guy, if he comes to this maneuver, and he has to get his sherwani, right, so he will give the fittings and all, he will do the trial, and it comes to him after, say, 1 month normally. In the ladies segment, if you go to, say, Mohe, or say this Ritu Kumar, or these other, uh, Manish Malhotra and all, they take like 3, 3, 4 months. So there are no as such sourcing capabilities. What Manyavar has, Vedant Fashion has done is they have set up basically this Karigar network in mostly Calcutta only, where most of the things are done there. How they have separated themselves from the others is they have developed a strong ERP system, where the inventory management is very very strong there.
Great. So I think this is a question that Amit had. Let me put it up. This was more to do with, how, I mean, Vedant Fashions does have a great opportunity size, but any light on the cash conversion cycle, working capital days, etc. I think this is
Right.
something which we'll cover,
Yeah, in the
or
forensics. But normally, yeah, you can hear my voice.
yeah, yeah, I can hear. Go ahead.
Okay. So normally, but it will be on the higher side only, because normally the franchisee fees and the inventory, it stays on the books. So it will be on the higher side. But but how we can see the truthfulness of the inventory, if I put it that way. Normally, I have seen if companies are doing fraud, or what they are showing is not true. The receivable more than 6 days, they do very less provisioning, or historically they have been written off. So in Manevar's case, that wasn't there. So that is why I was also confident This was my query also, that okay, everything is wonderful, company might be fudging books, or is it the nature of the business? But I then have come to the conclusion, never say never, I might be wrong also, that this is the nature of the business.
Great.
That I'll show in
Uh,
the forensics which we had done basically.
okay, okay. Vikas has a question. I'm gonna just put it up. Apart from VFL diversifying into different categories, what's their strategy into getting into deeper into T2, T3 towns? Do they have any plans for expanding outside India?
Right.
And any sense on the store count in these areas?
Right. So broadly, if I tell you, so Vedant Fashion has around 230 odd stores. Out of that, 12 are abroad. So in the last con call, also they told that they would be gradually going abroad, and that also in areas where the Indian diaspora is very high, say Dubai, and towns in USA, UK, where the Indian diaspora is very high. And recently they are, I think, setting up a shop in LA also, where the Indian diaspora is very high. So I think there are around 950 odd towns in India which are having a population of more than 50,000, right? Manevar is right now in 220 odd cities. So I think till they reach that 950 number, by that time that 950 number would also reach 1900, 2000. So that market size I don't think is an issue, especially in Manevar's case, because Manevar Titan are more or less at the same store count. Titan is at 220, Manevar is at 230.
I mean, I still remember. I think initially they had ventured quite, I think, in a grand way into the Middle East. And you're absolutely right. This whole strategy of targeting the Indian diaspora into specific key markets is something that they've worked on.
Right.
So I think Amit, your question on the working capital cash conversion cycle, Satwik will take up in a bit when we get into the forensics. That's the last part of the presentation. There's one more question by Romario. How is the management track record?
This all we'll cover in the forensics and the fraud search.
Great, great. So, I mean, over to you, Satwik. You
Yeah,
can straight away get into.
the
Uh,
most boring part of the presentation. So these are hard numbers. Yeah, so before I delve into the numbers, I would like to showcase you how I kind of do the forensic accounting. So there is only one way of writing honest accounts and infinite ways of manipulating them. So if I, as a promoter, I have to showcase my numbers every quarter. I am a listed entity. I normally am a smart guy where I know what the investor community, what the analyst community would be looking for. They would be looking at sales growth, आया profit growth आया, but that's it. No more. Most of the analyst community tracks on a quarter to quarter basis, right? They do not look at the cash flows, balance sheet, because the annual report only comes say 6 7 months down the full financial year ending, so the notes to accounts are not there. So so as a promoter I try to showcase increase in sales and profits. And how I might do that, I might be overstating profits, resulting in overstating fixed assets and receivables. So high fixed assets, high receivables, says 20% increase in sales is there. Historically there has been same amount of increase in receivables. That means actual cash is not coming. Low cash conversion. There is cash on books of, say, Satyam Computer, cash on books was sitting of 800 crore, but no other income was there in the income statement, right? Whereas good companies like say Piramal and all had a decent 5 6% yield. In case of lenders, especially banks, right? What companies do is they have given analyst estimate कि we have to do 4% nim. When that nim doesn't come, right, and their NPS sort of increase, they write off the NPS through the balance sheet while transferring it to reserve. Then, in say a PNB case, Punjab National Bank case, the contingent liability as a percentage of net worth was more than 200% due to Nirav Modi and a couple of other accounts. So we have to see that if things go from worst to worst, what might be the potential liability there, right? Then there are some other things, like say in very reputed groups there are intercorporate deposits, and we saw ILFS was one of large companies there. Then very high intangible assets, especially in case of acquisitions which are written off in the peak of the bear markets. This I've seen with a lot of companies. Right, then low debt or provisioning, I think Amit ji was mentioning that about the working capital cycle and all. So how do we know that this is true, these are true numbers? So I try to figure it out, that okay, whatever is more than 6 months old, money is not coming to me, I write it off. And what has been the track record there over the last 7 8 years, so that should be the provisioning should be apt, and the write off should not be that much over a cycle. Then real taxes and dividends cannot be paid out of fake profits. So the cash tax rate, not what is showed in the PNL, but what is actually paid out from the operating cash flow, what is deducted, that amount if should be at more or less what the government has mandated. Right now it is at 25 odd percent. Earlier it was more than 30% till a couple of years back. So now coming to maneuvers, what it has done is, so if you look at receivables to sales, right, it has been decent only, like whatever the sales has been there, so receivables are not growing at that fast pace. But if you look at the profit before tax upon CFO, so it has been consistently high. That means whatever the company is generating in profits, that is being converted into hard cash. It is so this shows that company is doing a very decent job. Then the cash yield, this is looking high due to some extraordinary incomes, but normally it is in the range of 4 to 6%. So this was also decent. There are literally no contingent liabilities as a percentage of net worth. A couple of tax cases here and there which you cannot avoid if you are in India. Return on capital, the true metric of a business owner, right? It is probably one of the or the best in the industry, if I had to put it that way. Consistently more than 25-30% over cycles. Goodwill as a percentage of net worth is almost negligible. This was also due to the Mebaz acquisition which they did for the South market. It is also very, very negligible. Auditor expenses are not growing, like it is into few lakhs only. Miscellaneous expenses as a percentage of sales are very, very low. These go to as high as 14-15% also in case of some companies. So normally what happens is, if the company is not listed, the promoter sees his the company as his personal property. Suppose if I have to buy an LV bag, I have to buy anything, right, for my house and everything, he expenses it to the company, right? So this is normally done through the miscellaneous expenses. So this was also more or less low only. So we thought that okay, the numbers are pretty decent. And one more interesting thing which happens is that when numbers are shown standalone and consolidated, no, normally analysts look at the consolidated numbers only. Standalone, they say okay, isko chhod do. But फिर क्या, then what happens is sometimes people hide most of their debt into one the standalone entity or the consolidated entity, right? So we checked that also, that okay, more or less it was 100% only. Say the operating profit or the profit before tax, the tax rate, CFO, because it was only the Mebaz acquisitions which was there. Rest most of the things were being captured in both the things, standalone as well as consolidated. And as it is, the company was debt free only. Now coming to a very other interesting part. So this I have developed through say past 8 9 years of say my biggest mistakes over the cycles. So in evaluate, Phil Fisher said this, in evaluating the common stock, management is 90%, industry is 9%, rest all the other factors which we evaluated, this mode, ye hoga wo hoga, mohe will happen, is only 1%. Now why is that? I'll tell you. Okay, if the management only is fraud, that they are looking to cash out of the money in times like these, when the markets are not doing good, they will write off big goodwill, they will do very dubious things with the company, they will take say very very high salaries and all those things, do a random acquisition out of nowhere. These things happen. So to do that, I kind of have developed a 150 keyword fraud search. So this normally, how I go about it is, first I look at the promoter quality. What is the history of the promoter? What has been his background, his family, where which all are his other unlisted companies, what business are they in, whether they are into similar businesses, right? What is the family debt position, whether there has been any pledging in the of the company shares, conflict of interest, court cases, litigations, so on and so forth. Then there are a lot of interesting social media portals also, like Nitin Mangal does a very good job at fraud search. Then Value Picker is there, Money Life, SOICY, Ishmohit, Contrarian EPS, India Kanon. Then whether the auditor is resigning, very regularly, there are huge CXO level exits regularly. What is the auditor pedigree? And one more important thing which I have realized recently only, in the top 10 investors, whether they are some shady investors. So normally, there are some investors which we know that these kind of delve into insider trading, so on and so forth. So we have now kind of made a checklist also of those investors who do. So now you must be thinking that okay, this all is theoretical, but how do you, like, what is the actionable insight out of this? So I obviously cannot take names because I run a PMS, but there is a leading diagnostic chain CEO was found with unaccounted cash. They have pledged all their stake in the company and have had very questionable real estate acquisitions, and they have done like decently well since the IPO, right? Then a leading QSR chain, the business I like a lot, but they have been pledging their shares, the company, putting money into their loss-making adhesives business, and are having questionable royalty demands. There is another marquee FMCD company from a very, very reputable group. The company is cash rich, right? Is making fans and all, generating decent cash flows, zero debt, having 30% ROCE, but they are taking loans from the promoter and they are giving them interest at 28%. So this clear cut shows that the promoter is wanting to take out money from their company. Then, like many real estate companies, leader of the previous bull market of 2018, where I lost like decent money. So I did not realize that the promoter had lot of political connections, had been caught with unaccounted black money, had been involved, and their family had been involved in demonetization, cash conversion, and some murders and all also. So when this news was out in the market, so that is how I the share price went for a toss. So now this framework I have tried to put for maneuver basically, right? So I'll just take you through in a minute because there was nothing significant which came out of it. So how I go about it is like look at the management, what the history has been, right?
So,
So
Satwik, I mean, what is the source of this document? Is it the DRHP? How
right,
did you
right.
make this Word doc?
So, it is a very frankly, more than the research on the business model, this document preparation of these 150 keyword, this only takes at least, 100 odd man hours. So, basically, a good week is spent here only. So, it is mostly Google search only. So, if you look at these court cases and litigations, you would find it at India Kanoon or say Case Mine, right? Now, in some companies, the litigations are only running into hundreds of pages, so you have to read them all, right? The promoter background you can find through Zoba Corp, right? Like what are his other companies, the other companies, what kind of directors they are having. Then Value Picker, you find good threads which take away your decent time. So it is combination of Google search and some specific sites which we have probably identified for this, and this is an evolving process. So every time we learn new things. So I'll give you an example. Earlier we only used to do it through India Kanoon, the litigation cases, but then we realized that okay, case mine also is a good material for Indian specific cases. So we added case mine also through our basically this framework. Then for say labor related issues, earlier we did not look at that, but when we are looking at these kind of companies which have intensive labor usage, like say a Trent or a Maneuver, we kind of look at labor strat also, right? Where if any labor unrest are there, it gets captured there. So broadly, it's a mix and match, and it keeps on evolving.
Interesting. Uh, do you have anything more to present? Otherwise, we'll straight away get into questions.
Yeah, so so that this one thing I'll just show you. So basically, what is the outcome of this fraud search for Manyavar especially? So I normally looked at the background of the promoters was through DRHP annual reports and some broker reports, and then obviously Google search. So the promoter background, then Manish Choksi, who was ex senior level executive at Asian Paints, then some other people were there. So more or less I figured out these are decent guys, and not just by my thinking, because there are no court cases against them, no serious litigations against them, have been part of reputed companies. So that's how I kind of make an estimated guess, right? Then another thing is which all are their directorships. So for all the directors, I look at what are their other directorships, right? So some like Kedara Capital guys are there, Manish Choksi is there, so on and so forth. Then the Zoba Corp details. Then another interesting thing here is, so how are the related party transactions going on? So here also I found out nothing serious is there as such. So this was also decent. Then what are the entities forming part of the promoter group? So normally what happens is, the promoter buys real estate in a separate company, and the company which is doing good, so how he tries to take out money from there is he charges heavy rents, like say double triple of the market rents to that company. This is very very prominent in a this e-commerce retailer which has been listed recently, like one of the good companies which has been listed recently. Promoter has a company where the real estate is parked, they bought it, and the this listed company is paying heavy rent. So these kind of things also you kind of try to figure out. So in Manyavar this was not there. Apart from this, so this I was talking to you about, so these litigations and all. So since Manyavar was a recently listed company, you could find them in the DRHP, right? The 500 odd page DRHP. If you read it fully, you will find all the litigations against the company and by the company. So there was like literally nothing serious there. So and if you and here also now you have to try to figure out like what is the okay area. If you are like, now I will only invest in 100% clean companies, oh that will never happen only, because something or the other litigation or criminal case, or say 1 crore tax case would be there against the company if you are running business. So here also we have to segregate like what all is acceptable and what all is clearly we cannot just invest because the company is not clean there. So yeah, so this was more or less this, and then like finally you see what are the claims against the directors through the DRHP, and then this India Kanun, so on and so forth.
Interesting. So, Satvik, any concluding remarks before we get into the Q&A?
More or less, I think so. This was a good stock-specific discussion, but I think the Indian retail sector and specifically the consumer sector, so that should do pretty well going ahead. And here, if we can identify, companies which can double their profits in say 3 to 4 years, where there might or might not be potential for valuation re-rating, I think good money is to be made. Good part here is in consumer monopoly kind of businesses, stocks recover also fast. So for I'll give you an example. So say in demonetization or this COVID time, if an NBFC fell or a bank fell, you would be very scared how it would raise its capital and all. But say PVR fell in COVID, revenues were zero, it hit all-time highs. VIP industry, Safari hit all-time highs now. So they bounce back also very fast, provided their dominance is there. I think it is a pretty good sector to look at.
Okay. So, we have a few questions. Let's take them up. Hemant has a very interesting question. How can the management keep a tight grasp on working capital since it's a FOFO model? And what are the conditions for someone to become a franchisee owner? Would not FOFO dilute the operational performance? So, just adding a layer of my thought on this, when I did my research on Titan, I had met a few franchisee owners, and the whole process through which Titan shortlists a distributor, I think that sort of compares to as good as something like a school or a college interview, or probably
Mhm.
beyond that, right? They do your background checks, they do your net worth check, and then, if you have anything somewhere, something tainted, they'll probably not even think of giving you a franchisee, right? So any thoughts there, Satwik, or
Yeah.
anything
So like,
confusing?
I had also checked, especially for Manyavar and a couple of these other retailers. So firstly, there is a significant net worth requirement. I think more or less at least in double-digit crores, and there is an upfront investment amount also. So in case of Manyavar, if I'm not wrong, so till last month for a 2,000 square feet outlet, if you had to look at a Delhi kind of outlet, it would be at least 1.5 cr. So that amount of capital only very few people would be having, and apart from that, if you have any industry experience, that is more or less preferable. And coming to the working capital cycle, and dilute the operational performance. So I think what Manever does is they help in the hiring of the people also. So they have a very robust HR team which is hiring people also to run the outlets. And the designing and all, it is done as per what the maneuver is doing. So I think that is not an issue. And regarding working capital, I think it will be on the higher side only because of this model. Security deposits are there, elongated cycle is there of the customer conversion, and the end uh, outcome coming in.
Okay. And Satvik, as far as the retail stores are concerned, everything is not on FOFO, right? Or I think you mentioned about two models, or everything is on FOFO.
Yeah, so for Manevar it is mostly FOFO only. They have few of their own outlets also. So there are two kind of models. One is franchisee and franchisee operated, where say if Saket is opening up a franchisee, he's only looking at the end-to-end people also, right? And other is the franchisee owned company operated, where you are say like an market investor. You are investing in Manevar, so you are investing in a Manevar shop in say Park Street in Calcutta, right? It is that sort of business where the whole end-to-end operations and all are taken care by Manevar only. So Manevar is very less on the FOCO model; it is more on the FOFO model, and they have around 10% of their sales coming from the company-owned outlets also.
Okay. Uh, this is a question from Vedant. Where do you perform the keyword search? Can't the most words that come out of promoters' mouth be driven by a PR campaign? I think this is a very interesting question. So, any thoughts here,
So,
Satvik?
the keyword search is mostly done on Google only. So, I'm not looking for some keywords which have. So, here what I'm looking at are the negatives, right? Whatever worst can be done. This PR campaign driven will be done if I'm looking for, the optimistic kind of scenario that, okay, say hyper scaling company will double its profits, monopoly, 95% ROCE, that kind of things. If I was looking at that, could be done by a PR campaign. But if a legal case is there, or say ITR, say income tax department has conducted a raid, if hard cash has been found in large quantity, so these are hard facts which are reported on India Kanun. So if anyone has any court case or legal case any against them, it will be there on India Kanun if he is an Indian citizen. And then there are obviously these forensic checks which we do through the numbers. So now again everything is not 100% sure, right? But these are all guesstimates where we sort of try to reduce our risks.
Interesting. Sunil has a very interesting question. How were IPO funds utilized? What was the purpose of going public for such a high ROCE business?
Right. So see, IPO fund. So the company does not require capital. So IPO was mostly for giving an exit to Kedara Capital and the promoters cashed out. So that is a hard fact because the business doesn't require any money only. So what would we do with the IPO funding? So this has been a pattern also I've seen. So this other healthcare company which was listed recently, they are also doing 75 odd percent gross margins, having 25% ROCE. They also did say 80% went back to the promoters and the existing investor, which was a private equity fund, and 20% was in the company. But Maneuver, I'm sure going ahead also it would not require any capital. Like that's what I think, given its business model.
Interesting. Uh, do you have any projections made for this company? You did mention towards the initial half of the presentation that when you look at companies, you look at that hyperscalers. So, is
Right,
there
right.
any?
So see, what my calculations are, 500 CR PAT it should do by FY24. This year I do not know, but the last 2 years, if you look at that COVID all impact also happened, so true numbers would not. So my broad calculation is, so current whatever the numbers are, FY22 it should have ended at around 380 400 odd crore. That is what its quarterly run rate is in steady state scenario. So minimum 500 crore PAT should be there. Now if Mohe scales up, that can be higher also. So this will be a 1,000 crore PAT company, like say by FY28 odd. Like that is what I think.
Interesting. Maneuver has gained market share. This is a thought by Ujjwal by robust advertisement. Will they be able to do the same in the women segment? So I think Ujjwal, this was fairly discussed. In case you missed that part, you can like always scroll back and see. So Satwik did mention about what Maneuver has. I mean, what the management has guided that once they see the per SFT sales number go from 6 7,000 odd to 10,000, that's when they'll start doing the hyperscaling in the women's segment, which they've already demonstrated what they've done with Maneuver, the men's segment. And
Other thing
as
is
far,
few
yeah,
interesting things they are doing. So like earlier they used to advertise Manevar and Mohe separately. So then they what did the advertisement with Kartik Aryan ki tayar hoke aiye, and then there was this another advertisement of Manmoh, right? So Manevar and Mohe. So basically the bride and groom, or say the guest, the baratis, both of them should can shop from Manevar. So that is how the positioning they are changing to. That it is not only the bride or say the barati, the guy who should be shopping there, the ladies can also do that. That is how they are branding uh, through the advertisements.
interesting. Uh, Another interesting question from Vikas, or rather thought, generally in franchisee model, the company sells the stock to franchisee, which then the franchisee is responsible to sell. So why would the company have long
So
debtor days?
yeah, so in case of maneuver, security deposit, because of security deposit they are having like long debtor days, basically. Like that's what I had analyzed. So security deposit they are taking late from the franchisee. That is the reason for the long debtor days.
All right, and just a continuation of that, he mentions how does or let's say how does PAT of VFL compare with page and valuation of both companies if you've done any exercise otherwise.
So I think that some old numbers were there which had captured from the DRHP of Maneuver. So I'll just try to share those. Okay, so Page is not there. So there are these other companies like Asian Paint, Titan, Britannia, Dabur, Marico, Aditya Birla Fashion here. Yeah.
Wait, let me put that up. All right. Yeah, you can. No, I mean, Satvik, I think the screen got removed.
Okay,
You
so
can.
basically Page is not there. So there are these other companies there.
You want to put that up?
Okay, yeah, just Yeah, yeah. So
Yeah.
this is there. So if we look at the basically the net profit margins, so the Maneuver has the highest compared to the players mentioned here. Then the operating margins also. But if we look at the scale, so Maneuver would be at a lower scale. So if even if so I did some calculation. Even if we take say a 90 to 100 crore PAT every quarter, which it did in the last quarter, it would be at a 400 crore PAT, which is at a smaller scale than say a Page Industries or a Titan there.
Interesting. So, okay, I think that more or less is what we have from today's presentation. Thanks a lot, Satwik. I think we were able to do justice to people's time, and we'll probably it's almost 8:35 now. Maybe we can uh, have another 2 to 3 minutes and take some more questions as we wrap this up. So I think if I were to sort of summarize, and as you were presenting, even I was taking notes. You did mention about this whole. I mean, obviously, a lot of this thesis falls flat if the GDP per capita growth doesn't catch up, right? So that's the magic number to look for, and then you follow it up with the fact that once GDP per capita starts expanding, because India is that aspirational customer uh, sort of mindset that fits in, you see discretionary spends go up, which is what we've seen globally, and retailers are the ones who capture a lion's share of the value rather than, let's say, the FMCG companies or the
FMCG,
people
right?
behind. And with that in mind, what was very, I think, interesting is how you overlaid that with examples of a Zara, or how Trent was able to hyperscale that in India. And following on those lines, we do feel that Maneuver is a franchisee which is worth looking into. So, there's a question from Mayank. He's quite regular in all our webinars, where he does mention that what kind of forward multiple would you assign to VFL? Right now, it's almost trading at what, 30 times price to sales.
Right,
So,
right.
what would that, I mean, or let's say, what trajectory you have there?
So see, normally, like this might be very contrary, but all the money which I have made in the last 8 years, it has been buying at high P, selling at higher P, right? DMart, when I bought at 150 rupees, I sold it at 4200 rupees. Same way, Bajaj Finance, I bought at DMart, I sold at 200p, bought it at say 50 60p. That was before the IPO also. When the IPO came, I bought it in the unlisted market. So normally, what I have seen is till the time growth lasts in the company and the industry dynamics are okay, right? Market would not derate it, right? Markets never derated because growth is very scarce. So there was this report by Goldman Sachs also that only 4% of the companies in globally are growing at more than 8%. So you can imagine what scarcity growth is there, of growth is there, right? So so valuation I normally tend to avoid till the company is executing. Having said that, if you look at a trailing P multiple, it would Maneuver would look at very insane multiples, or for that matter, if you look at Trent P would be some 500 600 if you look at it, right? So P and all doesn't work in this. How will you justify this? 20 years a Trent is trading at 200 300 P, right? So there might be some logic to it na, ki because the company keeps on executing that way. So but normally what I will keep on tracking is if the company is kind of delivering a 20% plus kind of a sales growth with these kind of return metrics, and if Mohe scales up, you can mark my words, valuation कम नहीं होगा इसका मतलब. But now the thing is, if the challenge is if the growth comes to say 10 12%, or say the incremental ROCE keeps on declining, then challenge might be there. Then you have to exit fast also. So so the game here is from the company goes from the emerging monopoly basket to the proven monopoly, right? That is where the whole wealth would be created.
Interesting. So, on that lines, this is what again Amit is a regular in all our webinars. What peg would you assign this? What's the growth rate that you're looking
So
at?
I am the last one you should look at for valuations. I rarely look at, so broadly have done calculations. So steady state maneuver Vedant Fashion would be doing a 400 crore PAT last year only if this COVID thing was not there, because normally 9500 crore PAT it is doing in steady state. So if that currently market cap is say 20 to 23,000 crore. So we can do that math, say probably whatever that multiple comes to be, say 50 odd times in a steady state scenario. But I can tell you it will never go below 50 times only till the company executes. It will go to 70 80 times only. That has been my like experience. You look globally also, Walmart is trading at 40 time P. Why? Because market is sure of its growth. It is growing at 6 7% only, but market is sure of its growth. Nestle will be trading at 15 time, 10 time. Unilever will be trading at 10 15 time. Why is that? Because market sees they are only 10% of the whole market. They can keep on reinvesting capital back. So markets always look at the longevity of the growth rather than what the trailing numbers are or the near term. So that is how the valuation is decided. Like, that is what like my experience has been. Even if you look at Bajaj Finance also, why is it given such a high premium? You could have invested in any tier 2 NBFC and you would have lost your shirt in 2018, right? Literally anything and everything fell apart. Only one guy was standing apart from HDFC, of course. Now that will be given a premium because markets are like, okay, I am happy that I will not lose my shirt here, but at least capital is safe here. At least I won't be down 70 80% if say funding crisis happens, because I know this guy can raise capital at 6 7 times and it can do a 20 25% ROE.
Interesting. So basically, what you're saying is that this whole multiple premium, I mean, is it's probably one can take a back view and say that okay, this is probably because of growth, quality of the franchise, reinvestment
Yeah. But then
capabilities.
the opposite part also is when the growth slows down, you have to exit. That is where I have been wrong, and that is how I'll keep on learning also. So, for example, Maruti, the growth was assumed at 15 odd percent, right? The whole industry only changed post 2018. Eicher was at 25 30% growth. Whole industry only changed. That time you have to exit also, right? Same way, DMart I exited recently because at say 200 I did a back of the envelope calculation. It can only do a 12% IRR if I keep it for 6 7 years. So that exit also has to be quick there. But till it is growing, so till that time you just ride the trend.
Okay. I think on your debtor days point, Satwik, Vikas had a follow up, and we'll take one more question and then we can close this. So he mentioned that security deposit, technically it would be a liability for VFL and not a part of the debtors. So any thoughts there, in case? And
No, so security deposit is received late. So that is how it was increased. So because they are having such good relations, so my analysis was some security deposits are being received late from the people who are say running 2 3 franchises and the first one has been successful. That is how the debtors days
or
was.
probably they are not calling it security deposit; they are probably calling it brand
Yeah,
fee or something. Because
right,
if
right.
you
So there were
technically
two
say
three
security
segments
deposit.
there. But one caveat is there. I am like the last person you should go for the numbers part. So I do you can say a broad kind of a framework and then look at the company executing on key parameters. If you ask me what the PB and all will be, I'll be the last person.
Great. So, and I think what let's say viewers who have tuned in live, or let's say who would be watching this later. I mean, I have had the privilege to know Satvik for a while, and I mean some of the work that he's done. In fact, we worked on a few ideas together, some of which have been multi-baggers within a year or two, or let's say within even let's say some of those spans. So uh, I won't say that you're someone who goes broad based, but yeah, there's always scope for getting more work done. So thank you for sharing those insights. Uh, Vikas shares a thought: moat of VFL lies in low inventory rejection rate of 3%. This is because of demand forecasting and better optimization. How will this change in the economy segment, and any further insights?
So
I don't
economy
think they are
segment.
going into the economy segment, right? Or is
No,
that
no.
the
So
case?
they are expanding that the economy segment, which is that basically 150, 200 kurtas. So
Okay.
they are doing that, but that will be a very small part. The true, if you ask me, one thing which will change the trajectory of VFL, it will be the Mohe only. All these would be here and there only because there is no proven player here also which has created wealth, or for that matter done decent revenues also in this kurta segment and all. So I don't think udhar bhi kuch hone wala hai, matlab at scale, matlab which will move the needle. They might do 100 crore revenues in 5 years. How will it matter to us? By that time, Manevar only will do 2500 crore, only Manevar. So that would move the needle. That will only be done by Mohe only.
Interesting. So, I mean, that's all we have, Satwik. There's some love also flowing in.
Okay,
People are
thank you.
saying about how, this presentation was epic. And, for viewers who are still tuned in, just drop a fire, or, just drop a thumbs up if you liked what Satwik presented today. While this was something which was very well condensed in maybe an hour and a half, but as Satwik mentioned, it almost took him 4 months to come to this whole thesis and finally put it out in the open. So congratulations on that, Satwik. I personally enjoyed this a lot. Thanks a lot. And in case you want to follow up, or continue listening to what Satwik has to say, he's on Twitter. He's fairly active, posting stuff on Twitter. So that's pretty. I mean, uh, I do read a lot of what he has to post. So his social media handle is below. And Satwik, any thoughts you have before we conclude this?
So one thing was that the questions were very intelligent. I think I I should be sitting on the other side because yeah, they were like very pointed, and the quality of questions, you can see the kind of audience, it is like vastly different. Otherwise the questions are market kya lagta hai, nifty abhi kitna aur girega, what will Fed do? I have zero idea there. Here at least I have some idea.
Great, great. So, thanks a lot, viewers, for pouring in the love. Yash, Mayank, Sami, Nishmit, Anand, Jayan, thanks a lot. And hopefully we'll come again and bring you some more high quality work. You can share this video with your friends. If you want to stay up to date with what further webinars or content we are putting out, you can subscribe to Beta 2 Alpha. The link to that is in the description. And wish you a great week ahead. Uh, thanks a lot, folks. Thanks a lot, Satwik, for your time.
Thank you
And
everyone.
we'll wrap it up.
Thank you.
Thank you.
Bye, take care.